The information in this recording is general in nature and should not be considered personal advice. Please consult a professional and qualified financial advisor to discuss how this information may apply to your personal circumstances. Thanks for listening.
Hi, Dane Pymble here from Life First Advice, and in this update, I want to walk you through the performance of our asset allocation strategies to 30 June 2026. More importantly, I want to take you into the mind of an asset allocator in this update. So the headline is that our strategies continue to perform ahead of the benchmark since inception, and that's pleasing. But more interestingly, in more recent times, some of that relative performance has been given back as broad market indexes have continued to move higher while we've taken a more defensive positioning in the short term. And I think that creates a useful opportunity to explain how we think about portfolio positioning, risk valuation, and process. The update in one sentence is this, that since inception, the strategies remain well ahead of their benchmarks, but in recent months, our performance has softened. And that's not because the portfolios have changed direction dramatically. Largely, it's because we've deliberately remained more defensive while markets, particularly global equity markets, have continued to rise. That can be uncomfortable, and clients naturally see market indexes moving higher and ask whether we should be participating in that more fully. And that's a fair question. But asset allocation is not about being right every month. It's about applying a disciplined process over multi-year timeframes. So today, rather than simply report the numbers, I want to explain the thinking behind the positioning. So on this slide, you can see our return since inception for the two strategies benchmarked against the relevant index, which is the Vanguard index for each particular risk profile. And the important point is that these aren't just short-term monthly numbers. They cover the strategies since inception, which for now have been operating for 3 years. Not still, not a super long period of time, but starting to generate a track record over multi-year timeframes. And that matters because any active managed strategy will move through periods of relative strength and periods where it lags. And the purpose of tracking performance since inception is to avoid becoming overly emotional about short-term movement. A client recently asked me a question I really liked. They asked, how satisfied am I with the current portfolio positioning? I thought that was a really smart way to frame the issue. The easy answer would be to say that I'm only satisfied when we're outperforming, and that's the ego talking. But the reality is that asset allocation requires accepting periods where you might look early on a trend, late, or wrong in the short term. The real question is whether the positioning remains consistent with the process, the evidence, and the risk-reward opportunity in front of us. So am I satisfied with the current positioning? Broadly, yes. Not because it's felt comfortable, it's actually been quite uncomfortable, but because it remains consistent with our methodology that we've committed to following. The reason we have remained defensive is not because we know a downturn is imminent. We don't. But the methodology that we draw upon certainly is indicating a strong possibility of one. It's more because we've not believed that investors have been sufficiently rewarded for taking additional risk in certain areas of the market. Much of the recent strength in global equities has been driven by a pretty narrow group of very large companies, mainly linked to the AI theme. Those companies may remain outstanding businesses, but outstanding businesses can still become expensive investments if expectations move too far ahead of fundamentals. Themes can stay popular for longer than we would like, and they can run well beyond what we think is fair value. And that doesn't mean that our process should just chase them simply because prices are going up. Our question is always, is the expected return worth the risk from here? One of the hardest parts of portfolio management is watching something that you don't own continue to perform. And that's been true with parts of the market linked to mega cap technology, semiconductors, and AI infrastructure. Those areas have contributed heavily to recent index performance. But not owning something that is going up is not automatically a mistake. The question is whether that investment met our criteria at the time. If a theme is expensive, crowded, and heavily dependent on optimistic assumptions, and I think suffice to say the AI theme certainly fits the bill there, we need to be careful. We may miss some upside in the short term, but the alternative is abandoning the process simply because the market's rewarding a different type of risk for a period of time. And that's not how I want these strategies to be managed. It's also worth noting that some of the themes that we like at this stage of the cycle have underperformed recently, particularly things like commodities, and in particular gold and copper miners as well. We've started to we've liked those themes, but we've also stepped away from them in more recent time because the risk and reward was becoming less attractive. And that decision has been somewhat justified by the recent underperformance. The important point, though, is that stepping away from a theme doesn't mean abandoning it forever. In fact, as we sit here in late August, some of these areas are starting to look quite interesting again. Gold and copper miners in particular. They're moving back towards levels that we think warrant a revisit in the coming months. But again, the discipline's not to buy just because we like the theme, it's to buy when the valuation and risk reward justify the allocation. I want to change tack now and briefly touch upon Australian residential property, not a direct investment into our asset allocation strategies, but the research methodology that we draw upon certainly influences the advice we give to clients who are looking to build residential property portfolios. Late last year, we stepped back from recommending new investment property purchases. That decision has served us and clients pretty well, particularly following the May 2026 budget and the weakness that we've seen across all major capital city markets. Some cities like Brisbane and Perth, we might sort of see a recovery there earlier than others. But direct property is not an asset that you should be assessing the potential over the next few months. It's lumpy, liquid, and expensive to buy and sell. If we're going to recommend new direct property investment, I want to be confident looking out over the next 7 years, not the next 3 to 6 months. At this point, I'm not confident that the expected return justifies the risk of new residential property investment purchases over the next year or two. It may change, but for now, I still stand by the view that caution remains appropriate. The important thing is being defensive does not mean being passive or closed-minded. We are always actively looking for opportunities and looking at valuations. We're watching in particular where the market leadership broadens beyond this narrow area of the market that's been driving a lot of the recent performance. And that, like I mentioned with the commodities piece, that is potentially starting to happen, which is what's getting interesting for us about potentially increasing the growth exposure in the portfolios, particularly in that area. And we're watching things like inflation, interest rates, and central bank policy. A lot going on there. And if you haven't seen it, I put out a video on the potential upside risks in inflation and rates. You can find it on our YouTube channel. We're watching whether earnings expectations remain realistic, and we're watching the areas that we've previously liked, commodities, even emerging markets and small companies as well, to see whether the risk reward improves. And I think particularly EM and small caps, they are still at, relative to history, very low relative valuations to developed markets or large caps. They're kind of opposites. So there's a lot of strong relative value there, but relative value doesn't always equate to potential returns, but it is still interesting for us, and we may look to re-enter those sectors as well. And linked to that, if the evidence changes, the portfolios can change. And that's the whole point of active asset allocation. Positioning isn't fixed because we want to be proven right, as much as my ego likes to be right. It should evolve as the evidence evolves. So what should clients take from this update? I think the first thing is that strategies, remain well ahead of benchmarks since inception. And secondly, that recently relative performance has softened because we've been more defensive while markets have continued higher. Thirdly, that's not a reason to abandon the process. It is one of the realities of disciplined asset allocation. And fourth, we're not going to be chasing the hottest parts of the market simply because they've recently performed well. Finally, we are actively looking for opportunities to increase growth exposure at the moment where valuations and risk rewards justify doing so. The goal is not to be right every month. The goal is to make disciplined decisions over time. Asset allocation is not about predicting every short-term market move. It's about applying a disciplined process that balances opportunities with risk in the service of long-term client outcomes. And there'll be times where that process feels very rewarding. There'll be times, like recently, where it feels a bit uncomfortable. But performance should be judged over multi-year timeframes, not isolated periods where the market rewards a narrow set of assets, which we've chosen not to chase. As always, we'll continue to monitor the evidence, communicate the thinking behind the portfolios, and make changes when the risk reward justifies doing so. Thanks for watching.